Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing global payment stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Global Payments provides payment processing services to merchants, allowing them to accept credit cards and debit cards, along with other payment types. In return, Global Payments receives a percentage of the transaction value, usually about 1 to 2%. GP was spun off from National Data Corporation, its former parent company, in 2001. The company is headquartered in Atlanta, Georgia. It trades on the New York Stock Exchange, Deutsche, Borse, Mexican Bolsa, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 35 billion market cap. They're trading at 120 a share, and they have 290 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So their free cash flow looks really good. It nearly triples from 900 million to 2.4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's gone up from $500 million to $1 billion. Revenue is the sales for the company, and that goes up every year from 3.4 billion to 8.3 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that doubled from 2.3 billion to 4.5 billion. Below that is their operating expenses, and then their operating income, which also peaked in the trailing 12 months at 1.3 billion. They have over 11 billion of debt on their balance sheet, so they pay 331 million of interest payments on that debt. And the bottom line of the income statement is their net income, which looks really good, growing from 484 million to 955 million. This is the company's income statement from their most recent 10Q. This shows us the first 9 months of 2020 versus the first 9 months of 2021. And the top line is the revenue, the sales. That went up from 5.5 billion to 6.3 billion. Below that is their expenses. The cost of services is 2.8 billion. Payroll and technology costs are part of cost of revenue. Selling, general, and administrative expenses. This includes payroll for support functions. It may also include depreciation, amortization, rent, insurance. So their operating income went up from 642 million to 1 billion. Their interest expense went down from 258 million to 246 million. They paid 132 million in taxes, and then income before equity investments is 676 million. Equity method income is 94 million. You don't get taxed on equity method income. So their net income is 771 million, which is a lot more than the prior period last year of 420 million. When Global Payments owns part of another company, they can report that as equity method accounting or cost method accounting. If Global Payments has significant influence over another company, it reports their income as equity method accounting. Usually a company has significant influence over another company when they own 20% to 50% of that company's stock. To give you an example, say Global Payments own 30% of Company Y, and Company Y reported $100 of net income on their income statement. Since GPN owns 30% of Company Y, GPN would add $30 onto its income statement. If GPN had $500 of net income, that's after taxes. Then they would add $30 onto that and report a net profit of $530 on their income statement. You don't get taxed on the gains from equity method accounting, like I showed you on their income statement earlier. Since this is a non-cash item, we reverse it out on the statement of cash flows. You're going to see on the statement of cash flows in a little bit that we're going to add back that equity method amount. But if Company Y pays a dividend, then we would add that on the statement of cash flows, since a dividend is a cash payment. Net income is not cash. If Global Payments did not have significant influence over another company, say it owned only 5% of another company's stock, then it would use cost method accounting. They would record the cost of the investment as an asset on its balance sheet. and the value of the asset doesn't change regardless if company Y reports a profit or a loss. Although if company Y pays a dividend, the asset decreases by the amount of the dividend. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generate lots of cash flow, 1.1 billion up to 2.8 billion. They invest from $200 million to $450 million a year in CapEx. This is investments in property, plant, and equipment. Most of the CapEx spending is in their technology. If they were a manufacturing company, they may have to buy a lot of real estate, a lot of warehouses. Operating cash flow minus CapEx gives you your free cash flow, and they have lots of free cash flow remaining each year. So they do pay a small dividend, but another way to reward shareholders is to buy back stock. They bought back $200 million in 2018, then $300 million, $600 million, then $2 billion. When a company buys back common stock, it reduces the shares outstanding. It makes your shares more valuable because now you have a bigger piece of the pie. It looks like they do add debt most years. In the trailing 12 months, they paid down $3 billion of debt, but added $4.4 billion. So they increased their debt load $1.4 billion in the trailing 12 months. You can see they had $1.4 billion of investing cash flow, $460 million in CapEx. That's about a $900 million difference. That $900 million may be an investment in another company, because when a company has lots of free cash flow and adds debt, it's likely they're acquiring another company. Let's look at their statement of cash flows from their latest 10Q. This is the first 9 months of 2020 versus the first 9 months of 2021. The first section in the statement of cash flows is cash flow from operations. And the way you calculate that, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the $771 million. We have to add back depreciation of $292 million, amortization of $973 million. Only intangible assets can be amortized. And the only way you can get intangible assets on your balance sheet is when you acquire another company. You cannot internally generate intangible assets. Goodwill is the most common intangible asset. That's when you acquire a company and pay a premium over their net assets. They pass through $68 million of capitalized contract costs. There was a company GPN acquired, and they had a contract in place already. So GPN acquires that contract. An example of this is if a company wants to work with GPN and they pay $1 million upfront for a 2-year contract. And that contract may entitle the company to use all of GPN's services. So the company GPN acquired, they received all the cash up front for that contract, and they put it in the liability section, not the asset section, the liability section. And then every month they reduce the value of that liability and pass through revenue onto their income statement. They don't want to book the entire $1 million of revenue up front. They want to spread it out over 24 months, since the company was paying for a 2-year contract. In addition to an employee's salary, they also receive stock, and that's a non-cash item. So they're reporting $146 million of stock-based compensation in the first 9 months of 2021. Provision for operating and credit losses is the revenue they don't expect to receive on their receivables. That's a non-cash item of $73 million. They're reversing out $136 million of taxes. They label this deferred income tax. A company reports income tax on their income statement, but that's not the actual taxes they paid. That's the taxes according to GAAP, generally accepted accounting principles. The taxes they actually paid was what the government told them to pay. Deferred income taxes are taxes the company will eventually pay, but they're not due yet. The way deferred income taxes come about is the difference between GAAP accounting and the way the IRS calculates taxes. The difference is mainly due to the way the IRS takes into account depreciation and the way GAAP takes into account depreciation. But over a long period of time, if you looked at the taxes the company paid and the taxes according to GAAP, they will equal. But at any particular time frame, they're going to be different. And this is different from income tax payable. Remember earlier we were looking at the income statement and they passed through a gain of $94 million on equity investments? That's a non-cash item, so we have to reverse that out here. It looks like they extended $123 million of credit, so that's a cash outflow of $123 million. But when the customer pays for the item, that'll be a cash inflow. Even though they reported a profit of $800 million, they actually generated over $2 billion of cash flow. Let's look at the other two sections on the statement of cash flows. Cash flow from investing and cash flow from financing. And this is the first 9 months of 2021. This is 2020. In cash flow from investing, they spent $350 million in CapEx and nearly $1 billion from acquiring other businesses. So they had a cash outflow of $1.3 billion in their investing section. In their financing section, they added $250 million from borrowing money on a credit line. They added $4 billion of long-term debt. They paid down $2.4 billion of long-term debt. They bought back $1.8 billion worth of stock. They received $39 million from their employees who bought stock. And they had a cash outflow of $85 million from the repurchase of stock from their employees. They had a cash inflow of $46 million from contribution for non-controlling interest. This is when another company acquires some equity in a subsidiary of GPN, and they paid out $188 million of dividends. So in their financing section, they had a $310 million cash outflow. Last year, they had a $594 million cash outflow. It looks like the main difference was this credit line. Last year, they paid down $31 million. This year, they borrowed $244 million from that credit line. This is the equity section on their 9/30/2021 balance sheet. They have $26 billion of equity. They raised $23 billion from selling their business, and they profited $3 billion from running their business. Accumulated other comprehensive income are unrealized losses. So maybe in the future, they're going to realize a loss of $243 million. This may be from derivative contracts or pension plans. Those are the most common things in accumulated other comprehensive income. Let's look at their capital structure. They have $26 billion of equity, $11 billion of debt. They're 70% equity, 30% debt. Their net debt is $9 billion. And I calculated their WACC of 8.12%. I usually give a WACC according to Finbox or Simply Wall Street, so you can see where I got the number from. But if I got to change the WACC, I kept my calculated WACC in there, which is fine because it's a little higher, so it's more conservative. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's $50 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $45 billion. We divide that by 290 million shares. And we get a calculated stock price of $155. They're trading at $120, so they're trading at a 22% discount. It's a buy according to the model. The average analyst projects their revenue to grow 8.3%. I grew their revenue 8.3% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by these 4 revenue numbers. And that comes out to 26%. So I multiplied their future revenue estimates by 26%. Simply Wall Street is higher than me. Their valuation is $247. They're saying the stock is 51% undervalued. 18 analysts priced this stock and the average price target was $197. The low was $151. The high was $240. This is where the stock has been trading the last 2 years. So you can see the stock crashed last March when the market crashed. Then it doubled from the bottom, but it's come all the way back down because the market has been really struggling the past few weeks. But this stock has been struggling the past few months. So it could be a great buying opportunity. There's tons of sell orders. When you see a red bar down here, that means the sell orders are higher than the buy orders. When you see a green bar, that means the buy orders are higher than the sell orders. And the higher the bar, the more trading activity there is on that stock. They raised their dividend a ton from 1 cent to 20 cents back in 2019. Now it's up to 25 cents. It's still a pretty small dividend, 83 basis points. But they can easily afford that. It's 30% of their net income, 12% of their free cash flow. Their industry pays a 1.4% dividend, so they're lower than their industry. And analysts are projecting them to decrease their dividend to 70 basis points. But you can't just look at dividend. I bet if you included the share buybacks, then they gave more to their investors than the average company in their industry. A positive sign is when a company is adding employees. Their employee count has grown a ton since 2015, and it doubled in the past 2 years. If you put $10,000 into this company 10 years ago, even with the big stock decline recently, you'd still be at $54,000 today. That's an 18% annual return. So this stock has beaten the market. But just a few months ago, your $10,000 investment would have been close to $90,000. In the beginning of the year, there was a couple of sell orders, but in the past few months, there's only been buy orders. That's generally a good sign when insiders are buying the stock. The biggest shareholder is T. Rowe Price at 11%, then Vanguard, Wellington, BlackRock, and State Street. Let's look at their financial ratios. Their PE is on the high side at 37. PE is stock price over earnings per share. Price to sales is decent at 4.2. They have a really good price to book of 1.3. Price to book is stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. It's the book value of your company. So their book value is $26 billion. Their tangible book value is negative $10 billion because they have lots of intangible assets on their balance sheet, nearly $36 billion. They have a pretty low return on invested capital of 3%. They can cover their interest payments 4 times. They also have a low ROE of 4%. They have a good current ratio and quick ratio of 1.2. They have $2.3 billion of cash on their balance sheet, $900 million of receivables. Since they're constantly processing payments, so at any given time, they're going to have lots of transactions that haven't been settled yet, because it usually takes a day or two to settle. So they have $1.9 billion of assets that need to be settled. So they do seem to be well capitalized. They have $2.3 billion of free cash flow in the trailing 12 months, $758 million of working capital. Working capital is current assets minus current liabilities, and they pay $290 million in dividend payments, so they have $2.8 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 6 other companies in the same industry as GPN, and if GPN has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So their PE is a lot worse than average, so is their price to sales. Their price to book is one of the best on the list. Their current ratio is fine. Their ROE is on the lower side. They're the largest company on this list at $35 billion market cap, pretty close to Copart. Their dividend is a little lower than average. So to summarize, I have them trading at a 22% discount. There's always demand for credit card processing companies, whether we're locked in our house all day or whether we're free to go out and shop. People need to use their credit cards to buy things. If crypto gets a lot bigger, that may replace credit cards, but I don't see that ever happening. So this definitely seems like a good long-term hold, and I think the company is pretty generous because they're always buying back lots of stock, and they do pay a small dividend. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation, or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.